Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to break it up into our normal components of the overview and then going deeper into refined products and then going into the global market and what's happening with exports. So one of the things that we really want to look at before we, really dig into the overview is just summarize quickly. So like we said last week, we expected to see a bump in gasoline demand and we got that. Now we expect to see that slow down. And then the same thing where diesel and jet fuel also had a pair back in terms of demand. But, the question is always going to be what comes next as we come out of summer driving season with Labor Day really marking that end. And there's really something for everyone. When you look at the numbers, there's really nothing that's overly bullish and overly bearish. It's kind of a very normal number for this time of year, which if you could say just based on expectations, that is bearish based on where the things sit heading into the shoulder season. But right now, we had crude that had another draw. We finally had that little bit of a build in Cushing, so we expect to see some of that stabilize. Exports remain under pressure as things had gotten a little bit softer, which made the WTI and Brent a little bit cheaper against Dubai. That has since started to reverse a bit. And then we did get a little bit of firming in the international market after some of those prices came down as we come into the end of the month and then start to prepare for not only just September, but then also what's going to happen with October as we're starting to get some of these loading schedules. So just diving into the crude oil inventory here, and I should say before we get to that, please like, share, subscribe. Your support is appreciated. So when we look at crude oil inventory, and we're going to keep excluding the SPR because as we know, the Biden Congress is going to release another 20 million barrels, and we're supposed to see another drawdown really over the course of through 2027. So the SPR is going to continue to move lower just based on what the expectations are and what the acts of Congress are. So that's when we're just going to look at what is in commercial storage right now. And you can see now we're above where we were in 2019. And this is what we've been talking about and what we've been calling for is that the pace of draws is going to remain slow. We're going to keep getting draws. We should get one more draw or one or two more draws, I should say, before we start to see and come into this build period, which is really normal. When you look at 19, you look at 18, we typically start to come into a build period as we come into shoulder season which is really the fall. So when we start to see that, so we should see a little bit more of a draw. It's something that we've been talking about. It's just the pace won't be that aggressive just because we're starting to see some softness in demand and we still have a lot of floating storage sitting just offshore now above the 5-year average, which we'll talk about in a minute because that's something that we weren't really expecting to see the speed at which some of these boats have shown up. But we'll talk about that in a minute. Then when we look at the days of supply, you can see it's very stable at 27.2 days. This is a mixture of what is happening within storage and then what is happening in terms of refinery run rates. And then you try to figure out, okay, well, what do those look like? And here you can see that we still have a lot of crude in storage based on where the run rates are and how the runs have been going, which again, as we go through September, and one of the things that we've been talking about, we weren't going to see this big drop off or this big, these step downs as we've seen in previous years, just because we never got to those levels. So when we look at where draws are, where refinery run rates are now, we just think it's going to be a more gradual move lower as we progress through the remainder of August into September. And then when we look at this, when we look at U.S. commercial stock, and then we factor in gasoline, distillate, jet fuel, and residual, you can see just where we sit at the moment. We're still following and pacing 2019 pretty closely. This is something that, again, as we've been saying, the pace is going to be very slow, and it's just been a very steady move down after coming and starting at really record rates. in terms of what was in storage overall. And refiners have been trying to manage this. How are they managing storage? Well, they had refinery run rates very low so that they could draw down some of that crude, pull down some of that additional product, and now you're starting to get into a more of a normal market as we come to the other side of Delta and we start to get ready for, hopefully a more normal season going forward. Then when we look at gasoline had a bit of a drawdown when we look at what it is in general. And just to give you the numbers before we go into the deeper dive, we had a draw of 2.24 million. And you can see it's still, again, very steady moves. And when you look at just the general cloud, given that we typically see draws this time of year, but as we've been talking about, it's just been very muted versus I think where expectations are. And when you look at storage, you also have to consider there was some let's call it weirdness into the end of the week, which was with Henry, because a lot of individuals rushed, based on the news coverage, it was the end of days, people rushed to get gasoline in case they lost power, so you had guys getting gasoline for their generators, their cars. So we'll have a little bit of that. Some of that was covered in this report. Some of it will be covered in the next report. So there'll be a little bit of a balance. But also it's important to consider that people that filled up and, maybe topped off just won't have to get gas as soon. So that's where we'll see some of that, normalizing over the next week or two. So then when we look at distillate had a small build of about 650,000 barrels. You can see that we typically get builds here. So there's really nothing crazy. The storage still remains low. But we still have a lot of jet fuel kerosene builds. So that's something where they'll start to manage that. We could see some of this move into the disti cut. But so far things are fairly normal. But when we look abroad, we have more distillate, or I should say really diesel at this point, coming from Asia into the Atlantic Basin. That'll keep pressure on our exports. And this is something that refiners are going to try to manage so that they keep storage at a fairly stable clip. Then we had, this is the build that we were talking about in jet fuel, continuing to grind higher back to the highs of 2021. But this is something where there's a lot of mobility and movement that they can use to try to manage some of this movement. So we don't expect to see too much in terms of this getting much higher, because there's ways that they can adjust this over the next few weeks. Then when we look at the crude curve, you can see that the front month has just come down, but we still, when we look down the curve, things still look fairly normal. So there's really not much to say one way or the other. We're still above 65 as we get into really April of 2022. We're still above 60 as we get into the end of 2023. So there's still more than enough opportunity and running room for the U.S. to make money and U.S. E&Ps to make money within this curve. So there hasn't been too much adjustment over that period of time. And then when we look at COVID, just to provide an update on where cases are, you can see cases have been fairly stable worldwide. The U.S. has starting to come to the other side of Delta, which is a net positive. One of the bigger concerns is when you look at the UK, you can see that there was a peak, but then things really stopped going down. They flatlined a bit, where India has seen a fairly steady move down, with Asia Pacific remaining elevated. One of the things that we're starting to see is when we look at Japan, Malaysia, Thailand, you're starting to see that roll over a bit, which is a positive in terms of new cases. So that's something that we'd like to see continue, so that we can get a little bit of this uplift from Asia. But right now, Asia's long a lot of diesel. The monsoons have really increased increased the impacts to farming within India, a lot of the industrials. So there's that right now they're long a lot of diesel. So we're starting to see that get put into the market. So that's going to be something to watch when we look at what is normally happening. Typically the monsoons, obviously they have monsoons every year. It's just where they hit, the length of time has impacted some of the harvest and some of the plantings, which again is just going to impact when they're consuming some of this diesel. So that's something where we've seen that drop. That's going to get pushed into the market, and that's not something that's really driven by the Delta variant or Lambda variant or anything that we want to consider. as you can see, it's been a very stable move down. So these are things that we'd like to watch. Australia is obviously still in their lockdown. They've expanded it till September 21st. Then when we look at some companies, Ford has kept people work from home till 2022. Just another of those companies that have come out to say that. So then when we look at crude stocks, you can see that we had a draw of 2.98 million. That takes us 40 million below the 5-year average. But again, it's just a matter of how high 2021 was. But we'll break that down in a bit more detail coming up. And a lot of that was driven by PAD 3 and PAD 4, with PAD 3 down 1.42 million, but that's still 400,000 over the 5-year average, because PAD 3 still has an excessive amount of crude that they're trying to move through. But with exports being under pressure and some of these imports coming through, that's where we'll see PAD 3 really struggle to see some of these draws, and it's just really kind of flatline at this pace, where Cushing had a build of 70,000 barrels. Yay, finally got a little bit of a build, but again, the pace of builds is still going to be very slow. We don't see really a big spike coming anytime soon. So it's still 14.2 million below the 5-year average, and we don't see that adjusting with, and then the EIA has an estimate of 11.4 million barrels a day of production. We have us closer to right now 11.5, and that's just going to be a matter of when do they do their calculation again, some of that makeup. And we just released our article in the AOGR magazine, just talking about what's happening with frac spreads, what's happening with rigs, and where do we see going into Q1 into Q2 of 2022. So then when we look at land storage, stockpiles fell by 3.6 million. You can see that it was really driven that we had some nice draws out of the east of Suez, where things west of Suez have been fairly stable. And now that when you marry that together, you can see that we're still within the cloud, but we're still below that 5-year average, which is still a net positive. The question is going to be, what does east of Suez look like? Because things still remain uncertain, if you will, within Asia. And when you look at floating storage is still very high in Asia. And it's just going to be a matter of timing as to when does that go from offshore to onshore, which again will fill some of that gap. And one of the things that when we're looking at storage in general, we expect it just to go sideways, not really coming down, not really going up. And when you look at just where the 5-year average is, because we normally get draws this time of year, the comps get much easier. So that's going to be, put a little bit of pressure on, I think, some of these adjustments or some of these expectations coming up. And here's where we look at the floating storage. You can see that when we look at the west of Suez, things are starting to pick back up a little bit, still below the 5-year average. We don't see that closing that gap really at all. It's going to come down. What happens with West Africa? What happens with some of these other components? So when we start looking at some of these shifts, the question is going to be the west of Suez, which I think is going to stay below the 5-year average, but a little bit of an increase, where when we look at east of Suez, which is factoring the Middle East, Asia, the Middle East came down a bit. We expect that to go back up. But again, Asia just remains very elevated, which is going to keep us sideways. And when we look at that timing, that's going to keep us well supplied when we're looking onshore, especially when we consider all of the disruptions that we've seen in China, looking at a lot of these ports. That's something that we're going to cover in segment 1 of the Econ show. That is just disrupting how quickly some of these barrels can get from the boat onshore, which again is keeping some of this elevated as well. So then when we look at road fuel demand, you can see that North America, or I should say the Americas, has seen a little bit of a bounce, which is a positive as we get into that last push as we head into Labor Day. China had a little bit of a bounce. That's something that we think is going to stay closer to about that 90% of normal. And then when we look at Europe has come down closer to seasonal norms. We still see some activity in general. It's just going to be a matter of, where does that go from here, where the rest of Asia still remains depressed. That's starting to peak up a little bit, but again, there's still some of this overhang with COVID and the Delta variant, which is just limiting the amount of activity within Asia. But in China, they haven't had new domestic spread of COVID, or so they say, but they still have some restrictions, in place that is just keeping mobility fairly flat. So then when we look at pad 3 in terms of storage, this is what we're talking about. When we look at the storage levels, you can see that we're, just 16 and 20 were higher, and we're still off of the 2021 lows. And that's going to be, how do refiners manage that, given what's now in floating storage, what is an onshore storage, and what is the cut that's going to be necessary. And as we head into diesel demand getting picked up, that's going to be a little bit of a heavier cut. So we're going to see a little bit of this blend, which is why they have that crude sitting offshore. And they got some better discounts, they got some better rates, which also they were trying to be advantageous with some additional ESPO coming into pad 5, just based on some of those prices that have come down over the last few weeks. So then when we look at Cushing, you can see right here, we're finally starting to get a little bit of a peak higher. We're still below the average in general, but you can see that we're starting to, just right at that level. And we expect it just to kind of flatten out and start to see some of the steady increases over the next few weeks. Then when we look at imports, imports were down another 194,000 barrels a day. That's over 1 million barrels below the 5-year average. There was pretty much a drop across the board. Pad 2 was the only one that saw an increase of 351,000 barrels a day, in line with what we were talking about, where we expected to see Pad 2 see that increase. But we were expecting a little bit more out of Pad 3, where Pad 3 had a decline of 122,000 barrels a day. And this comes down to that timing that we were talking about, where we see an increase on offshore storage, but we had a decrease in imports. So it's just going to be a matter of when do those come into the market. And then Pad 5 had another decline of 226,000 barrels a day. That's something that will reverse. That's just going to be a matter of what that lumpiness that we keep talking about, given they have their own issues when you're looking at the ports. And it's just a timing of when they purchase and when they're coming over, because we still have a lot of barrels coming from Asia into the Americas, with right now on the clean fuel side, we still are at about 610,000 barrels, 610,000 tons that are coming versus a week earlier of 680,000, where 2 fixtures were changed while no shipments were added. So just seeing some of that is peeling off, but you still have a lot of that heading over into the Americas. And then coming back to the India monsoon season has hindered the recovery in diesel demand, with flooding disrupting construction and agriculture activities, leading to that additional export. And then when we look at South Korea, gasoline exports in July rose 28% month over month. So again, that's something that's going to continue as we saw through August and even into September. So then when we turn to crude runs, it was up small by 65,000 barrels a day, which is, when you break it down to percentages, was up 0.2 or 20 basis points from 92.2% to 92.4%. Just very normal versus the 5-year average. As we've been saying, we never got to where we normally go over the last 5 years, but now we're coming back into some of that normalcy, just because when you look at what normally happens this time of year, the comps get much easier. We were expecting to see a little bit of a pickup in Pad 3. Instead, we saw a decline of 137,000 barrels a day, with an increase instead in Pad 2 of 118,000 barrels. That should likely flip, and you'll see that really kind of hold at this level. But we're going to start to see some of this slowdown as we go through this week into next week, and bring us closer to about 92% as we move forward. So then when we look at implied demand was up in gasoline as we said it was going to be. It was up 239,000 barrels. It's still 121,000 below the 5-year average, but again, up to that 9.57 from that 9.3, which was, we were saying closer to about 9.5, came in very close to where we were saying. And then when we look at distillate, had a decline of 219,000 barrels a day. We were expecting a drop from 4.3 to about 4, came in at about 4.1. So that's something where we think it'll be fairly sticky as we go through the remainder of this week into next. And then we had that drop from 1.67 of jet fuel to about 1.39. We were expecting about 1.3, so fairly close to what the expectations were. And then propane had a small drop of 80,000 barrels. But again, that just brings us, we're still well over the 5-year at about 1.08 or 1.089 million barrels a day of demand. And that's something that's going to remain, especially when we look at petchem demand and just where plastics are. And as we start getting into, let the fall season, but at the same time, you still have the harvest. So as the harvest continues, propane is used for crop drying, so that's going to keep things fairly elevated as the harvest progresses in through September. So then when we turn to floating storage in the U.S., you can see that we're now back above the 5-year average. And as we were saying, the comps get much easier. So as the comps get much easier, we expected to see some of this marriage going forward. And then we expect this just to essentially go sideways as some additional cargoes show up and others already get pulled into the system, which again is going to keep PADD 3 fairly, not really going back to the 5-year average, but again, just a little bit of an increase as we go through the remainder of August. And you're going to see this tick back up, probably closer to the highs, not quite the 5-year average, but maybe just below the 5-year average, just given the comps get easier when you look at just where that dotted line is. So it's not so much this huge increase in imports, it's just comps get easier, things start moving together a little bit closer to normal. Then when we look at PADD 2, as we were saying, we expected to bounce after these two moves down, and now it's back above the 5-year average. Again, we just expect this to average out closer to where we have been over the last 5 years. And then when we look at refinery utilization rates, here's what we're talking about. When we look over the last 29 years, we're just below that 29-year average. And as we were saying before, this is typically when you start to see a drop down in activity, and that's where we don't see anything that's going to change that. We expect to see a little bit of a drop, nothing crazy, and it's going to be very gradual, and I think very close to this 29-year average, just given demand is coming down along with along seasonal lines, but I should say more than seasonal norms, as we never really got back to normal, and now we're starting to drop along seasonal, but at a rate lower than where we typically are when we look at 2016 through 2019. So those are things that we're going to talk about in more detail as we go through segment 2 and dig into some of these different specific products and try to break out what's happening and what do we think is going to happen as we head into shoulder season.